if you're trying to find the right balance and then you adjust slightly every year along the way, you could be in a really good spot. Welcome to the Retire on Time Q&A podcast. I'm Michael Decker with David Franson here from Kedrick Wealth. As always, this podcast is about answering your questions with context. We don't want to give you that oversimplified advice you've heard hundreds of times. Let's bring context, the nitty-gritty, into the conversation. That said, remember, this is just a show. This is not individual financial advice. Text your questions to 913-363-1234, and we'll feature them on the show and have a good conversation. All right, David, what do we got today?
Hey, Mike, how can you do tax planning when the rules keep changing?
Because you just have to do the best you can. I mean, you don't want to throw caution to the wind and say, well, because I can't control the future, I'm not going to do anything. You can control what you do today. But there's a very important distinction between I can't control the future, so I won't do anything, and I can't control the future, but I'm going to find the right balance. So here's an example. Many people for several years said taxes are going up, which was a true statement. Mm-hmm. So let's max out your 24% tax bracket. Let's do everything we can because, man, this is Armageddon. It's sunsetting, and nothing's going to stop this thing. And why would any politician stop it? Because they need the revenue, because debt's all-time high. And so people paid a pretty penny converting IRA assets to Roth, some of them even going all the way to zero. And I've heard of, I didn't do any of these, but like $1 million, $2 million IRA to Roth conversions.
In 1 year?
Yeah.
Oh.
That's tough.
Because that counts as income, right? And so that seems like a lot of taxes.
Yeah.
Just off the top of my head here.
Just putting it lightly.
Yeah.
So then you pay out the nose in taxes, your account balances go down, but it's tax-free, they would say.
Yeah, going forward, their gains are tax-free.
And then this guy, you may have heard of him, Donald J. Trump.
Oh, yeah, that guy.
Got elected again, kind of shooting the moon. He somehow got back in.
Yeah.
And then he does the impossible again and passes this thing called the One Big Beautiful Bill. I mean, how he names stuff is just, it's like he's a wannabe stand-up comedian or something. I don't know. The things that come out of his head. Mm-hmm. But the One Big Beautiful Bill comes, makes the tax brackets, the tax-efficient brackets, permanent. There's no sunset on it now. And so all the people that were too aggressive, that got to the zero tax bracket too quickly, paid a pretty penny, and they're going to pay for it for the rest of their life. Not literally paying it in taxes, but they lowered their balance. And if you have less money, it's harder to grow.
Yeah. If you have more money in there, the compounding is just...
10% of $1 million gives you more money than 10% of $800,000.
Right.
And that's a compounding effect for the rest of your life.
Yeah.
And then you need to consider too that for your entire life, you've got this thing called the standard deduction, which a lot of people don't really understand, that if your RMD is roughly the standard deduction, guess what? That's tax-free.
Right.
If the standard deduction decreased and you paid a little bit in taxes, well, they don't typically tax the poor an arm and a leg.
Yeah.
Maybe it's 10%, maybe it's 12%, maybe they change it to 15%. But that's still better than 22, 24% or whatever the rate is in the future as well.
Right.
So it's not about getting to the tax-free environment as quickly as possible. Most people, that's not prudent. Very, very few times does that make sense that I've seen, because you've got the standard deduction as long as it's still there. So it's like going to the gym and trying to lose weight the healthy way. It might be slow, it might be painful, but it's the healthiest way to go about it. Mm-hmm. To slowly do controlled IRA to Roth conversions so that your IRA assets are at a certain point that then your income is the RMD that you already need to pay for, but you're maintaining it within a lower effective tax rate or lower brackets, and you're utilizing the standard deduction every single year, you're in a really good spot. And then the other part you need to complement with all of this is the Social Security provisional income tax calculation, which a lot of people don't understand. The provisional income tax basically takes your income, half of Social Security, and then runs a calculation to see how much of your Social Security is subject to tax.
Okay.
And it's not as simple as half or 85%. It's a blended tier. They call it the tax torpedo, but that's the negative version of it. I think there's a huge benefit to this as well. So it all goes to saying, when you plan based on fear and extremes, you're probably going to be taken advantage of. If you're trying to find the right balance and then you adjust slightly every year along the way, you could be in a really good spot. It's balance. It's the slow and thoughtful direction of the plan while acknowledging the strategies you want to implement and putting it under the right time frame. This year and last year, after the one big beautiful bill passed in our year-end tax planning last year and even this year, we're slowing down a lot of the IRA to Roth conversions because it's permanent, and we might be able to do enough that then they can maintain their effective tax rate, their standard deductions, and so on within a certain level, and still accomplish their goals. But it's boosting or keeping more money in their accounts, which gives them a larger projected account balance throughout the rest of their retirement. Balance in all things.
Yeah.
Did that make sense, by the way?
Yeah, I think so. So it's just, there's a lot to consider. There's nuances, right? And we want to be in a position where we can stay flexible and not rigid and not just do things for the sake of it. Is that?
Yeah. I mean, here's just a fun thought to consider.
All right.
If your RMD is $1,000 more than the income you already want, big whoop. Just spend $1,000 extra that year. It probably won't destroy your plan. And if you're concerned about the taxes for whatever reason, then gift it. Qualified charitable contribution. You can just send it to a charity, not pay taxes. You're good to go.
Right.
Qualified charitable distribution. You can only do it with the RMDs. But it's like, okay, I was already planning to give money to the church anyway or a charity.
Yeah.
Here's the money. There you go. Your RMD is now within the tax bracket you want. It's the income you already want. It doesn't disrupt things. It's only a major issue if your RMD is twice the income you need. Then there might be some issues. Then you might want to be more aggressive on some IRA to Roth conversions for the time being. But rarely is that the case. There's this interesting balance I've noticed over the last decade of doing this, where the income people want is kind of around 4 or 5%, generally speaking, of the portfolio they've already saved.
Okay.
It's like they've organically saved the amount to get the life that they want. And then you include Social Security in there and optimize all that. And it's like a self-fulfilling prophecy. I can't explain it any more than that. But the point being is you've got income that you want. What does the taxes look like? What is the RMD projected to be? If it's already baked in there, why would you rush it? Maybe there's some health issues. I mean, and you want to do some more IRA to Roth conversions for your beneficiary's sake because they're higher income earners. But maybe you don't. Consider this.
All right.
Let's say your kids don't make much. That's okay.
Yeah.
And your retirement is in the higher income brackets. What if you didn't do a lot of IRA to Roth conversions so that they could enjoy your wealth, right?
Right.
Your IRA assets, they got 10 years to pull it out, but it's under their brackets, not your brackets. I mean, there's multiple layers to consider for this, but tax laws will always change. If you find the balance, then you can make subtle adjustments along the way. And if you can make subtle adjustments along the way, then you'd be more mindful about the balanced approach from now until the end of your time. And
I mean, how much of the tax laws actually change year over year? Is it really dramatic, or are there only some years where there's a lot of big changes? Is it mostly kind of level? Or can we even say? Can we quantify that?
It's political risk, legislative risk.
Right, depending on who has the majority in Congress,
who we vote for.
Yeah. So, I mean, that kind of goes back and forth, right? It's a pendulum, it swings.
But even like most of the tax cuts, based on my memory, usually had like a sunset, so it wasn't anyone's fault when taxes would go up.
Oh, right.
And then Trump comes and makes them permanent. And I'm not a tax historian on all of the different brackets. I mean, I have the data. I just don't know it off the top of my head.
That's a different podcast.
Every single shift for the last 120 years, not my specialty. But generally speaking, it's unfavorable to increase taxes significantly. So there might be a subtle adjustment to one group or another. But Generally speaking, if you are lower to middle class, I don't see a drastic change in the near future.
Oh, right.
I just don't.
Yeah.
It's more popular to want to tax the rich, which is a very misunderstood concept, by the way.
Yeah.
But yeah,
That's a whole other episode.
that's a whole nother episode. We got a lot of other episodes here.
Yeah, we do.
But I mean, does that? Yeah, politicians don't stay in power when you tax the poor.
Mm-hmm.
So who's going to say, oh, 10, 12%, let's make them all 20%. That's so
may
I
not
wouldn't
work.
make a fear-based decision and go to the 0% bracket. That actually can accentuate your losses or it would accentuate the distributions from your portfolio, lowering your overall balance, and that's harder to recover, harder to sustain. Be mindful, find balance. You kind of want to get closer to the zero tax threshold, about 85, 86 years old or so, and then just know your portfolio is going to grow more or less than your projections, so you also adjust along the way. That's all the time we've got for this question. If you enjoyed it, don't forget to subscribe wherever you get your podcasts or on YouTube. And as always, go to retireontime.com for the book, the workbook, workshops, and so much more. That's www.retireontime.com. We'll see you in the next show.